I'll go through the quick introductory slide, and we'll answer any questions, and then continue. Okay, guys. So remember, this is a live trading clinic hosted by Instatrader, and there's a risk warning. I'm going to trade live money if I see the right opportunity. So remember, spread betting and CFD trading carry a high level ratio of capital and result in losses that exceed your initial deposit. They may not be suitable for everyone, so please ensure you fully understand the risks involved. Now, the information and comments provided here in no circumstances are considered an offer or solicitation to invest. Nothing herein can be construed as investment advice. The information provided is believed to be accurate at the date and time the information is produced. Again, education only, guys. Content of the webinar is personal opinion of the moderator, not Intrader.com. The content is not constitute financial investment or tax advice. Intrader.com does not expect any liability with the content of comments made during this session. Okay, so the webinar, as always, guys, I'm going to do live charting analysis. I have a quite unique way of looking at the charts, okay, the hourly with the 15-minute view. I'm going to go through all that kind of stuff, the multiple time frame trading, which I do so well. The fundamental analysis, we've had quite a lot of data out, obviously, big repercussions from the non-farm payrolls that we did very well from on Friday. But the markets have seen a bank holiday, a little bit of quietness yesterday, but again, a new high has been made in the indices across the board. Then we'll do a real money trade if I see anything that is worth getting involved in today. If not, we'll just sit on our hands. These aren't designed for me to hold your hands and make you guys money. You have to do that yourselves. I can just open the door and show you what I'm doing. Then with the Q&A as always, and through this we can we can talk about anything we need to. A couple of questions before we start. So I just want to nail something straight down by Ahmed. Steve, can you review your buy advice on the Aussie dollar on the 25th of April? Turns out to be disastrous for me. Well, the reason why I read the risk warning at the beginning is, Ahmed, this is not me telling you what to buy or what to sell. I can make opinions, I can give you what I think the market may do, but I'm not here to trade for you. I'm not managing your account. So if you didn't do well for that trade, then I'm sorry, but that's down to you. That's your own trading decision. That's your own account. That's your own involvement in the market. There's nothing I can do about that, I'm afraid. And I'm not going to review, certainly not going to review anything of my previous advice, because it wasn't. It was market commentary going through what I believed the market was going to do. So if you want more market commentary now, I will give you that and I'll tell you. And if there's anything I see I want to trade, then I'll trade it in live money and I'll show you. Until then you're responsible for your own trading results. So any more questions like that, send them through and I'll answer them openly and honestly as always, guys. But right now, I can't make it any clearer than that risk warning that was that I spoke about. Okay. So what we're going to talk about today is obviously we're going to focus on the US dollar versus the Swiss. Now I picked this particular pairing because it trades very well technically. Okay, so we've seen a little bit, well not a little bit, quite a substantial move in the euro over the last kind of few hours with that data that's been released out of Germany. So we can see here in the euro dollar that it's spiked quite nicely, from here to these highs at 1311. So we're currently up about 50 ticks. So that's a good spike. So again, how many times do I say it? Let's just start off by going through the absolute basics, okay? So this is the euro versus the dollar. Got lots of levels here, lots of lines, okay? The market tells us what it wants to do. Okay, all these dotted lines are 50% retracements. The rest of the lines are higher time frame levels of interest. So daily, weekly, monthly, okay, areas of interest that people want to buy and sell at, displayed on a H1 chart. So how many times did I tell you guys? 80% of the time, an overextended move will retrace to 50%. So this just happens, again, to be great charting. The market starts off with the moving average. The news comes out with better than expected data out of Germany. Market spikes up. And the second hourly candle makes a higher high. So we draw our Fibonacci from the start of this candle to the end of the next higher high. We do this for two reasons, okay? The second higher high, we generally see a push, and then the move will either extend or retrace back into the previous candle. And again, we've closed outside the Bollinger Band here, and the higher high remains outside the Bollinger Band here. So that's two reasons for drawing the extension Fibonacci on them two candles. And within the next 2 hours of trading, the market breaks below 50%, can't get, again, much traction and much selling back into that previous candle. So the market closes with a reversal signal. Okay, find support on the 38.2. So where is it going to head to now? Well, it's going to break these highs again if it's going to continue to go up, and the market is going to test these levels here. So I would suggest really the market, if it wants to aggressively push higher, will get to the 1.31610. Okay, on the euro versus the dollar. So again, just to show you the simple charting techniques, and these are automatically drawn in for me. Okay, every time I see a higher high made with a close outside of the Bollinger Band, that's when we see the market participate. Okay, and then the market continue in these manners. So that's just a great bit of charting experience that people kind of draw anytime you want. Okay, when a hourly closes outside of Bollinger Band, makes a high in the Bollinger Band, start, finish, retracement to the 50%, market's going to retrace to 100 or continue to move higher. So again, we've got our key target levels up here, so the market's got plenty of room to extend on the high side before it, again, wants to retrace back into that range. So that's just an example of a bit of charting. You can see similar situations happen here in the S&P. Again, already traded below that 50%, but found support. Okay, market moving higher again. It's quoted on Reuters for the last 2 months, saying that it's still an opportunity to buy dips. Okay, so again, if you listen to my commentary on Twitter or any other trading advice, again, this was a great level to buy at in the S&P, just above the moving average, 1611.01. The market was finding good levels, okay, on the previous fibs. Again, other good charting techniques, keeping above the moving average, making them higher highs, making higher lows, market goes up. Okay, so where we're going to stop on the S&P, well, we've got this trend line up here at 1623.47, so a long way, okay, for the S&P to continue going up, but I still think there's plenty of legs. Not so much legs in Europe, to be honest. Again, I've expressed my concerns about the euro and the eurozone in previous trading clinics, so I'm still very much bullish the dollar, and I still think there's a lot of room to be tested on the S&P in the short term. So let's go back to the dollar versus the Swiss. So again, I've picked this particular product because it's an interesting fundamental and both technical marry-up. Okay, first of all, the Swiss, okay, is seen as a safe haven. Okay, it's seen as a store of wealth. It's seen as a pretty protected economy. So when people want to look and move large sums of money around, this is where they go. So I think a lot of the fear has been priced out of the dollar now, and that's why we've seen the strength in the US indices. But it's still that interesting battle between what's perceived to be safe, what's perceived to be where people are going to go and put their money. We've seen a big sell-off in gold. So does that mean the economy is getting better? Does that mean there's less fear in the market? As we know, there's no physical shortage of gold. Okay, so there's no physical. You can buy gold bullion bars on the high streets of Japan from vending machines. We know there's huge stores of physical gold in the reserves by UK, European and US banks. So there's no particular reason for gold to have a drastic sell-off unless the sentiment's changed and people think there's less downside risk in the economy and that really gold's topped and it's time to cash in their investments in the trade. So it's really been pushed up by the speculators. It's nothing to do with physical demand. So when we look at the dollar versus the Swiss, it's a similar situation between that and gold. So really, you can see that the market, again, has printed this very nice Fibonacci extension pattern, which I've used again. Close outside the Bollinger Band, we make a higher high outside the Bollinger Band. Fibonacci from the start to the finish. Well, the market again opens up round about the 32% after the highs have been hit. The market then drifts back down. Okay, so again, we've already hit the 100% and bounced off it. So what's that market telling us? Well, it's telling me in the short term, okay, and remember, not solicitation to buy or advice, just telling you what the market can do. The market can move down to here, okay, this trend line. We've seen the market has reacted very well in previous times off this particular level. Remember, tie this in with the Bollinger Bands. Okay, every time we're outside the Bollinger Bands, the market doesn't like to close below it. Okay, so close below it a couple of times here, but as soon as we don't hold on to them losses, the market then pounces back up and heads for the midpoint and then the upper end of the Bollinger Band. So really, we can kind of see momentum gained in the dollar versus the Swiss because we've touched the trend line, touched it, we're just above it, a little bit more above it, and again, look how these lows can't get anywhere near the trend line. So a bit of a a decision point here. Okay, we've closed below the 50% of this up move. We've now tested the midpoint. So how many times, okay, in previous trading has the low of the Bollinger Band's been hit? Quite a lot when you look. That Bollinger Band's had quite a lot of action. Okay, so again, we've stayed away from the trend line, but we've gravitated towards the bottom of the particular Bollinger Bands. So really, what we're going to have to look at now is how the market's going to react at 0.93875. Okay, that's another daily level of interest I have in, which ties in quite. It's not coincidental. It ties in with a 20-period moving average. Okay, these things in trading, as always, if they're right, have self-fulfilling properties. Okay, so the fact that this trend line is on the moving average is not a coincidence. That is a point of interest the market will look to test. So we've rejected the highs up here. Okay, so the market is looking to drift down. So really, we want to test the 100% start of that Fibonacci move, and we want to test the level, this daily level of interest here at 0.93875. So if we break through that, we've got another very, very defined level of interest. This is, again, a 50% Fibonacci previous point of interest. Well, and again, it ties in with the lower end of the Bollinger Band. So, I mean, these things are screaming out to us from a technical perspective. And again, if the market drifts towards it, it's going to eventually hit it at that trend line. So, there's two ways of looking at this. And again, I'm not telling you what to trade. I'm not telling you what to do. Okay? I'm just telling you how the chart's going to look in the next 5, 10, 15 hours. The market's going to do one or two things. It's going to find support on this moving average and move along this trend line here, and then retest these highs. Okay, so all these levels here are points of interest the market could test. Looks a bit messy, but that's just the way it is. This just means that each one of these levels, somebody has bought or sold on a higher time frame and found it of interest. So that screams that if the market is aggressively hitting these, people will keep buying it on the way up, because the trend on the hourly is still up. Or the market's going to hit these levels and grind down, okay, and look to test the bottom of these Bollinger Bands to squeeze any longs out of the market. People will then get value back lower at these prices. The market will continue up. Third scenario, I guess, is we break this trend line. The market again categorically reverses this uptrend and then starts hitting these lower trends and perhaps comes down to 0.92997. Right back to the 261.8 Fibonacci overextension. So I'm not going to make any calls here. I'm not going to tell you again what I think it's going to do. They're just the possibilities. But you have to pick. If you want to trade this or use this as an example of how to get into the markets, you have to pick what you think the market's doing right now. If you look at the monthlies, okay, these always look really messy because we've got all the higher time frames printed on, but we see all the actions down here in these white lines. But if you see on the monthly, that's a downward trend. Okay, that's a downward move. So very, very bearish on the monthly. On the weekly, not so much. Okay, markets move downwards, but we've retraced. Probably, again, when we see the when we see the down move, just do a simple Fibonacci. From the start of the down move to the low. Okay, well there we go, 50%. We've already retraced the 50%, okay, of this weekly move. So really, we've found value. Okay, we're just trading in a sideways range now. So does that mean the end of the down move is over because we've traced the 50%? Again, just by looking at your higher time frame levels, you're going to get coming down to see what the market's really doing now. So bearish, okay, but with a little bit of a recovery. Pretty neutral in weeks trading. We've retraced most of the downward movement on the weeks. Okay, then look at the dailies. Dailies, again, a mixed bag. If anything, I would say that's more bullish on the dailies. Okay, the market's moved up, rejected the highs up here 1, 2, 3, 4 times at 0.95510. The market's then drifted down, found short-term resistance here in a double bottom. So the market really, for me, on the dailies, is looking quite bullish. So that's how it's very difficult to see where you're trading in relevance on the small time frames, on the 15-minute and the hourly charts. So when you look at the monthly, weekly and dailies, they can have very contradicting pictures. Okay, so we go straight to the hourlies now. Then what's your view? Okay, so very, very negative still on the monthlies it looks like, but on the weeklies we've seen a majority of the market recover, and we've seen that we're really kind of trading 50% of the current downward move. On the dailies, really looks like to me there's a little bit of scope for upward movement. Okay, so again, you look back at my higher time frame indicators in the top left. We've got the stochastics, negative, negative, negative. MACD, negative, negative, negative. RSI in the range, but the close is negative, negative, only 1 plus. So in the higher time frames, okay, the monthly, weekly, dailies, the majority of indicators are pushing it downwards. So that means, for me, that if we've seen that the weekly and the monthly are slightly more negative than the daily, then what I would see is the market move down, even break this trend line here, but then the market will rebound up. So I wouldn't be selling into this market or selling into weakness. I'd be picking out opportunities in the dollar versus the Swiss of where the market could bounce. And the market could really quite easily bounce down here for me at 0.93520. That just looks like a nice little bull trap, to be honest, that the market could quite easily push through the moving average, push through the low end of the Bollinger Bands. We're not talking a lot of movement here. So 27 ticks, all the way down to this level here, and all the way down, so you could push it down 40 ticks. Okay, trade outside this trend there for a little short while, maybe 4 or 5 hours, to use it as resistance. The market breaks through, overextends, because we've got all this room to target up here, guys. All this room. So for me, that's what the scenario I would see. The market drift off and look like it's going to sell off quite aggressively to pull all them longs out of the market, and then when it hits these key levels of support, the market's then going to bounce back and then really overextend. Now, we've seen lots of articles. I don't know how much you read, guys, but there's lots of articles that already analysts and journalists have conflicting views. That already they're seeing that the stocks are overpriced. I don't see the US being overpriced right now, and we're always going to break higher when we're testing new highs. So for me, the value is in selling the tops in potentially the DAX, more so probably the CAC, and depending on your view, maybe the Euro stocks. So I see these tops in the S&P as just targets to keep making higher highs. Unfortunately, in the European stocks, I'm just looking for a key level to be hit, to be rejected, and then I'll be shorting the majority of the European indices. But again, you have to tie up what you think with the fundamentals versus the technicals. And while we're still dip buying, there's still opportunities to dip buy in the majority of commodities. But again, when you look at things like the dollar versus the Swiss, you're really having a difficult playoff between the strength of the US economy, the strength of the global economy, okay, the worries and fears about gold, and the natural way that people flock to safe havens like the Swiss when they do see risks in the economy. So all these things are difficult to kind of weigh up and then make your trades upon. But what I would say is that the majority of fundamentals for me are saying that the Swiss is still likely to be an attractive place to hold store of wealth. So I'd be happier to let these markets sell off. I wouldn't want to sell into them, to be honest. Even though I know the market could go down to here, I don't want to go short into that. That's not the style of trading I want to do. I'd be much happier this aggressively coming off and then buying at all these levels, okay, knowing that the market will have a really good stab when it's down here to at least hit this trend line to test it as support, become resistance, okay? Okay, so Amish back in the room, and he's saying, is it worth telling people that the dollar versus the Swiss is 95% correlated with the euro dollar? Well, it's only 95% correlated with the euro dollar, depending on the time frame you look at. Okay, there's plenty of tools out there on the internet to see positive correlations and positive coefficients. There's no particular currency pair, in my experience, that is always 100% correlated, inversely or diversely or negatively. Okay, so yes, it obviously has strong connections with the euro dollar, but I mean that's a whole different style of trading. I mean, if you want to start trading coefficients and currencies against each other, that's a different style of trading. Right now, we're looking at the broadest and broad of fundamentals versus good key technical data. So again, we're coming towards to touch the moving average now, and this level at 0.93875, which I pointed out was a daily level of interest. So really, this is decisions time for the markets now. Okay, we've got really, on this hourly candle, we've still got 40 minutes for it to close, so we can see all different types of scenarios. You see, okay, the size of these candles that can be printed in the dollar versus the Swiss. So when momentum comes into the market, okay, we can see very, very big moves. So it's going to do one or two things. It's going to find that as a good level of support. It's going to say, right, okay, well, we've not retraced 100% of that move, so the next target is the 50, and then again to make new highs. Or we're going to crack through this daily and the midpoint moving average. We're going to break the lows of the initial move and then head towards the 50% area of support. The market can't do anything else. Okay, so when I talk about hashtag Bob levels, break or bounce, this is what I quote. Okay, I can't make trading any more transparent than this. That the markets will look to hit points in the range or in the extremes of the range. They'll do one of two things. They will break these levels and move on to the next point of interest on the high side of the downside, or they'll bounce, meaning that they'll bounce off these, that they're actually levels of interest that are then turned into support or key resistance. So it's a difficult way of trading, and again, I can only make trading as easy as I can. These are all my setups, and I have my setups designed this way because I understand them. Trading's different for everybody, but the whole point of being a chief market strategist, a trading economist, a real trader, whatever you guys perceive me to be, I'm just trying to make trading as transparent as I can. Okay, I've been in the markets for a long time. Okay, now I can go and quote, I've turned £7,000 into 11,856 spot 91 in the last 6 weeks in front of live trades, in front of you people. Okay, so I can't do any more than say the analysis and the trades and the things that I try and pick out work. Okay, we made £710 in front of 137 people on non-farm payrolls. I don't know anybody else that's offering these kind of things for free. Okay, so excuse me, but I seem to get a little bit annoyed when people question the methods or say that things didn't work for them. I'm not here to make you people money. Okay, that's not my job. My job is to explain trading in the most transparent way I can and give you all the support that I can at all times. Okay, so these things are very, very difficult to do. If I wanted to just trade for myself and continue making the amount of money I do, I'd just do that. I wouldn't do these things unless I thought I was giving something back to the wider economy, the wider, sense of trading. I don't want people to lose money in trading. That does nothing for me. Okay, it's not my aim at all. I want you guys to understand the best ways to understand how markets work and what they do. Markets are always searching for value. Okay, so perceived value is based upon different things. It's your higher time frames. That's what people are looking for, the bigger picture. The shorter time frames, the 5-minute candles, okay, the minute candles, that's for people that want to scalp and be in and out. But you can't do that on a spread betting platform. Okay, you're paying a spread. When you press the button, you're generally offside. So unless you've got direct market access, you have to start looking at a bigger picture. So look at your 15-minute candles with an hourly view. Every 4 15-minute closes, you'll get an hourly signal. That's enough time. That's enough time to trade and pay the spread. Then when you look above that, look at your daily, weeklies, monthlies. These are the points of interest the market will have to get to, because a monthly chart is the same as a minute, 15-minute, hourly chart. There's just more of them. Okay, so time is just time. Okay, time is just a factor in trading. The data is still the same. Okay, a daily chart will be made up of hourly candles. An hourly chart will be made of 15-minute candles. They're all made up of the same data, but it's viewing them in the right way. So when I say I look at hourly charts, that's just what makes me comfortable. Okay, I can hold on for any hourly chart as long as I'm not too offside. So if I've sold the market here, okay, and the market goes up here, I'll be out of the trade because we're closing above the moving average. We're outside the top end of the Bollinger Band. But why would I get short here? Why would I? All the things I keep telling you is to get involved in the extremes of the market. So when the market again breaks out in the dollar against the Swiss here, closes above the moving average, makes a higher high, we get short here. Why? Well, because we're outside of the Bollinger Band, and every time we do that, the market doesn't like it and comes back. Where's your point of interest? The moving average. If you just trade off Bollinger Bands alone, guys, you'd start to get a much easier understanding of how to trade with value. And if you tie that in with these levels like I've got, then trading becomes fairly transparent. The markets don't like. They want to always come back to fair value. So that's why you'll always see in trading the moving average be a point of interest. Now, it might take 5 hours, 10 hours, 15 hours to get there. But again, you have to understand where's the downside in the trade. If you're trading here, okay, so in the same example, market breaks up, closes outside the Bollinger Band, makes a higher high. So we've got short from here, okay? Got short from here. the market takes us 13 ticks offside. Okay, it finds support here, all along, but finally breaks down and gets down here. Okay, so you've gone 17 ticks offside to eventually make 47 ticks. Okay, so I mean that's a good risk reward. You have to wait a long time for it, but you know, again, it's not a high risk strategy. Okay, so Joanne's just asking a question. What moving average do you use with the Bollinger Bands? Well, Bollinger Bands I like to use because they incorporate a moving average. So instead of having a 20 period, 50 period or 200 period or day moving average, you can just use the Bollinger Bands. So it's just the standard settings. Okay, so you just put your Bollinger Bands in, and a MetaTrader, I stick to the basics. You've got a 20 period Bollinger Band, 2 standard deviations, applied to the close, and that's what you have. So the moving average, okay, of the Bollinger Bands is a 20 period moving average. So you've got 3 lines for the price of 1. You know where the market's going to find fair value, the middle line, and anywhere above or below, okay, these Bollinger Bands are overextended. So the closer they are, the more likely we are to have a break. The further apart they are, the more likely we're going to find consolidation. So Mr. C is just asking, do I counter trade all the time, or you counter and reverse? To be honest, this is one of the biggest lessons, Mr. C, that I try and teach all traders. I'm not a counter trend trader. I'm not a trend trader. I'm not a scalper. I'm not momentum. I'm not position. Okay, I'm not a FTSE. I'm not a DAX. I'm not an indices. I'm not a commodity. I'm not a lot of things. Okay, I'm not any one thing. I am market neutral the majority of time, which means I'm happy to buy or sell any instrument. I like trading against the trade a lot of the times, because the way I trade is I pick tops and bottoms. So, okay, we've kind of discussed as much as we can right now the euro, the dollar versus the Swiss, in that I think there's more room on the downside. Okay, we've rejected and found that support is now resistance on the 50% on the Bollinger Band. So, you know, here we are on live trade that I'm short. Okay, so just going short now. Okay, just so we all know that I'm not making things up, I'm now short the dollar versus the Swiss. Okay, so based upon what I've been talking about, that's my trading account now. Paid the spread, we're short. That's because we've rejected, okay, the close above the 50%. We've found that the 50% is now resistance instead of support. We've not made a high yet in this hourly candle, so I see a drift, a test below 0.93875, coming below the 0%, and I would like to see the trade hit 0.93646. So that's what I think is going to happen. I'm happy selling into it, not particularly. So if this trade goes against me and closes above the 50%, I'll get out. But it's a small risk trade to do that, I think. So let me just go back to the charts in general. So when I say that I'm not a trend trader, I'm not any kind of trader, I have my chart set up like this. This is a standard MetaTrader. Apart from these pretty lines and automatic things that are drawn in, this is a MetaTrader that anybody can have. So I don't look for... I just look at these 8 products on my overview, because these are the things that I've traded in the past and made lots of money from. So what I look for is an area to get interested in, okay, to do something. So again, the dollar versus the CAD here. We've seen the market again have this big sell-off. The market again, 1, 2, 3 times tried to get above 1.00578. So is that a good idea to go short? Okay, once that hourly closes. Okay, we can see the market is been quite happy to sell down here. Okay, we can see good Fibonacci's, you know, good solid points of interest where the market could get to. So all I'm trying to do is get involved in the market and understand where people perceive value. Because the whole point of trading is not knowing what other people don't know. It's all about knowing what people are looking at. Okay, so whatever people are looking at, I'm either going to go with them or go against them. And that's the real art of trading. So if people... But, you know, looking at all these things like Ichimokutu and all these, you know, different blogs and what the news kind of analysts are saying, then I know what everyone else is looking at. So I know if they're looking at that piece of information and they're wrong, I'm happy to trade against them until that corrects. So that's why things like Twitter feeds and reading, you know, emails from prominent, you know, FTSE and, you know, well, so like Bloomberg or Reuters, I should say, you know, from prominent news feeds. You know, that's a better way of trading the markets, because you know what people are looking at. Okay, so if that should answer your question, hopefully, Mr. C. So Carlos is just asking, would you consider 0.9370 an area of interest to look at as a possible long trade from the dollar versus the Swiss? Well, absolutely, yeah. I mean, that's the whole point what I was trying to say. You know, these levels are break or bounce. So for me, I still think there's a lot of room on the upside on the Swiss. Okay, I think we've taken out a lot of negativity from the higher time frame trades. So I'd like to see it drift off before it then again recovers. So right now, I mean, again, it's where you how long are you going to hold these trades for? I'm looking to hold this trade for maybe 2 hours. Okay, I've seen a rejection of the 50%. I think this 100% will be tested. If it breaks through, we can see some momentum, drag it all the way down to maybe this trend line, maybe not. Okay, but we'll have to see. You know, we found there's 2 areas of looking at it. We found support on that 0.9875 level, so maybe that's the low. Maybe that's the low of the day, and this uptrend here, these 1, 2, 3, 4 green candles, will continue to move up. That's the chance you've got to take. As I said, I'm not always right, but I believe we're going to push a little bit lower before we start to recover. But that's just my opinion. That's just based on my trading experience. Okay, so again, I know you don't give recommendations, but I have a target in gold of 144. Looks like it's going to break. What do you think? 50% fib? Yeah, absolutely, Joannas. 144.61 is where I think the market's going to hit. That's a key level of break or bounce that I've tweeted about 2 hours ago in the markets. So we've got the gold chart here. Yeah, 144.61. As I said, this is where the market could really kind of drag down to. It depends where you're short from. To be honest, it depends how much profit you're holding on to. But that's a key area of interest. If we break down below this level here, then we've got a long way to drift off on gold. But remember, monthly, okay, weekly, daily, gold's looking a little bit more bullish than it is bearish. So there's still plenty of buyers out there, but difficult to say what I would say is, if this market, here's one, if the market doesn't close on this hourly inside the lower end of the Bollinger Band, the market will generally make a lower low. So that will be your target, 144.61. So what I do is wait another 26 minutes and see if this candle closes inside of the Bollinger Band. If it closes inside, it wants to hit back up here to 1463. Okay, so that again is, you know, down to you to decide. But I would definitely try and wait if you can for this hourly to close. And if it closes in or outside, that'll be a very strong signal that the market's going to retrace, or it's going to really test these lows once again. So you're short from 1471. Okay, we've got a fair amount of profit to play with. So again, it depends how long we're going to hold this trade for. The market's already tried to retrace some of this red, previous selling candle. So the smaller this candle stays, the more likely it is that the market's going to try and test lower. Okay, so that'd be my view on it. Obviously, not my kind of trading opinion. Okay, so again, we've seen that the market now in the dollars to Swiss is just trying to edge up. So again, we're going to see support or resistance come into the market at 0.94032. So we've only got a relatively small trade, 3 lots. So again, until we've closed over the 50%, I'm still got the mindset that I can still average in negatively. So that's again sell into your original position the further offside you go. Not a technique everybody likes to do, but I'm an aggressive trader and I have a big account. So £22 offside of a £12,000 account isn't going to frighten me. So again, we can get as aggressive as we want. I can sell all the way up to that 50% at 94097, and I'd still expect some sort of bounce. Okay, so you've still got an opportunity to turn a losing trade into a winning trade. Just depends how aggressive you want to be, but that's why I always recommend you start off with smaller size when you trade, because it gives you somewhere to go. If you start off trading 20, 30, 40% of your initial margin, then it doesn't leave you a lot of room to go, guys, does it? No problem, Joannas. That's a great question, and that's the kind of question we should be having, to be honest. Looking at the markets objectively already. I mean, look at this hourly candle already. If this candle turns red now, then all the profit will be taken out of that, so the market's got nothing to do but then to move further down. Okay, so if we start going red aggressively in this candle and it closes red, then that market is gonna hit 14461. I mean, I'd be amazed if it made a lower low and didn't hit that point. But then that might be the overall low. So maybe that's the point where the market rebounces. Again, it depends on how long you want to hold a trade for, and again, how aggressive you want to be. So again, that candle now in gold's going red. So if it makes a lower low, I would be absolutely stunned if it doesn't hit 14461. But again, you need that momentum to kick into the market. Okay, John, do you think the DAX and S&P can keep making record high? Where's the limit? Well, excellent question, John. That's more like it. Well, as I said to you earlier on in the presentation, I still believe there's a lot of room on the S&P on the upside. And the higher the S&P goes, that will drag the Dow, the Nasdaq, and the European indices up. However, there will be divergence. From the reasons I've said about the fears in Europe, with the very, very high unemployment in Europe, with the very high employment out of Spain and Portugal. Now, I lived in Spain for 8 years, okay, so I know that the situation in Spain is fairly dire. So my view is that the market will keep making higher highs, certainly in the US, and the second the Euro stocks, the DAX, the CAC don't keep up with them highs, then I'd be getting short the European indices, because there's going to be some real... Because people don't like that kind of stuff. People don't like the indices not moving together. Before, when somebody said about positive and negative correlations, these positive correlations only ever work for a certain amount of time. And once the S&P stops dragging the European stocks up, then wow, we're going to see a real bit of divergence in the markets kind of move in a very unexpected way. So I'd expect that the S&P, the foreseeable future, will continue to make higher highs, and as soon as the European markets are not dragged up with this, then we're going to see some aggressive selling in Europe. That's what I'd say. Yeah, I mean, the DAX is obviously, yeah, okay. Well, that's just helping our shorts in the euro dollar. Okay, the dollar versus the Swiss, sorry. But yeah, the S&P, I told you the S&P is likely to hit. Okay, S&P is going to hit 21623.44. Okay, in the next 3 days of trading, that's what it's going to hit. Okay, so there we go. I can't make it any clearer than that. The S&P will be hunting for highs. The S&P will continue to bring the major indices across Europe and the UK up, because that's what people do. Okay, when we traded the non-farm payroll, the FTSE wasn't moving, but the S&P was gradually ticking higher. So we piled into the FTSE and went long. S&P then broke the highs, went 50 ticks higher, and we made money in the FTSE. So that's how you trade positive and negative correlations in that particular way. Okay, so the dollar versus the Swiss has just hit that 60% retracement. So again, that's going to come in. There's going to be a break or bounce level. The 50% obviously will be key. So again, I've just sold a little bit more of that level at 0.9432. Okay, so again, we've got the top end of the Bollinger Band, and the 50% is really going to be the ceiling. We break above that, we're out of the trade for a loss. But I'm still thinking that really we're going to see a bounce off these levels. But there we go, guys. That's just my particular view. So yes, so you're exactly right, John. I mean, the DAX and the European stocks are going to continue to make highs. Where they're going to stop, I don't know. We just don't know. I'd expect that the Fibonacci extensions will come into play. There'll be lots of Elliott wave theories. There'll be lots of things that the market participants will bring out, but the market's going to do one or two things. It's going to keep hunting and ticking for these areas of interest and tick higher, or it's just going to find a finite stop where that's enough, and people see no more value, and the market's quickly going to drift back to to the moving averages. So you have to look at the bigger picture, guys. I mean, the market for me, yeah, it could quite easily get to this trend line up here, but once it does, it's really anyone's guess, to be honest. I'm a historical trader, okay? I like to trade off what's happened to predict the future. I don't know what's going to happen in the future, so I really don't know about these highs. So I can only tell you, based on my analysis, that the S&P could get to 1623.62, and that's it for me. That's it. Until we start trading back in the range, I'm not going to be trading. So again, guys, if you want to figure these things out for yourself and where the market could possibly extend to, then you're going to have to go to things like Fibonacci extensions. So do an extension from here to here, and that will tell you where the percentage-wise where the market could go. But really, I would say stay long the S&P, the Dow, and the Nasdaq, and then as soon as the Europeans stop following suit, get short. Okay, that's just my opinion. It's what I think could happen. So Jack's just saying S&P hits 1625, then a big drop to 13. Right, okay, that's a very, very brave call, Jack, but I like it. And to be honest, I'm not of a dissimilar thinking. I could definitely see that happening as well. Okay, guys, we've only got a few minutes or so. Anybody got any thoughts or any questions, anything they'd like to ask about that? Just gone short again in the dollar versus the Swiss. We seem to have stalled a little bit there. Again, guys, I mean, this is all about the higher time frames. Look at your higher time frames and put these levels on your hourly charts. You know, if you want to be a significant intraday trader, then it's not about looking at 1 minute, 5 minute charts. You know, you're going to see too much noise, too many conflicting signals. You have to look at your 15-minute, your hourly charts, and your daily charts to see where the market could move to. There's 2 or 3 great opportunities every day to trade the markets, and have your chart set up like this. Because once you've got your Bollinger Bands on and your Fibonacci's, you can trade 8 products at once. So when I said that I'm not a stocks trader, a commodities trader, you know, an FX trader, I'll just trade anything that moves. So like this, guys, you know, have your screen set up like this. When we're trading outside of current value, or we're trading aggressively above the Bollinger Bands, then there we go. You know, that's how you can do it, guys. Look, gold, so again, I memean, the gold rejects hitting down from 14461 for Johannes, then that market's going to hit back into fair value. It's going to hit 146.235 because that coincides with the moving average. So, you know, you have to be sharp. You have to be quick on getting out your profit and making your decisions, because once that opportunity's gone, you know, it's gone. Okay, guys, anything else before we wrap this up? Yes, Joanne, I do look at lower than hourly charts. As I said, I look at the 15-minute charts. So if I want to trade the dollar purse, for instance, this is how I look at the charts. No, sorry, that's the wrong one. If I look at the euro trading charts, this is how I look. Hourlies versus 15 minutes. Okay, so there's no levels in place. I don't get involved. There's nothing I can look at. Okay, so on the hourlies, you know, you look for the market rejecting, making lower highs. So what's the market going to do? Well, the market drifts from here in the euro versus the pound on the 15 minutes. Then it wants to test lower. Okay, it wants to test, you know, down to 0.84276. But again, it wants to break the highs. You know, you've got the lines in place. So I'd look at 15 minutes, because each one of these 4 candles when they close show us one of these. So that's how I'd recommend. Look, if you want to look at 4 products, look at them this way. You know, look at them with hourlies below 15s. So again, guys, you know, it's not for everybody, but this is the way it works for me. This is how I've made my money over the years. Okay, so back to the overview now. We've seen that, again, the market is bouncing off this 60% now, so we're going to move a little bit lower. So we've averaged in, so we're nearly back on side now. So, again, this is just different ways of trading, guys. You know, I can only take you half the way there, please. Can we look at silver? Yeah, we can look at silver. Okay, 1 second. Let me just get that up. Okay, natural jack. They just drifted off. Okay, silver on the dailies. Okay, so silver, we've hit a very, very key level of support and resistance. Okay, at 27.94. So below that, the market wants to hit 26.11. On the upside, 35.37. So really, you're going to have to, you know, again, we're trading outside the Bollinger Bands on the dailies. We know when that happens, the market then rebounds back into value. So if the market closes on the hourly significantly below 27.94, then I'd see a further sell-off to 26.11. But that's a long way to go in the charts. So difficult one, to be honest, Ria, on that one. But again, you want to be following gold. Again, if you look at gold on the dailies, okay, we've hit the moving average now on the dailies. So 1431.03 is where the market could extend to. And again, that's going to be a Fibonacci retracement point of that whole move. So difficult one. Difficult. And you've got a lot of room on the Bollinger Bands on the downside on silver, so there's still a lot of downward potential. So 21.35, that's where the market could get to. Okay? Let's just go back to our overview. Okie dokie. So, again, rejected them highs in the euro dollar versus the Swiss, so let's see where that ends up. We're just in profit now on that. So again, I think gold is going to make these lows here. Okay, it's just touched and broke the previous low in gold in the hourlies, but we need the momentum to come back in. I'd be amazed if gold doesn't hit 144.61. Mr. C, yes, I mean these levels are automated. They're basically higher time frame points of attraction. So that's all they are, monthly, weekly, dailies. Okay, so in profit on the euro dollar, sorry, the dollar versus the Swiss. That's now my 29th consecutive live winning trade. Consecutive live winning trade. Okay? Just so there's no confusion. That's my money trading. That's not me telling you what's going to happen. That's me trading my money on the accounts. Okay, guys. Well, anything else, follow me on Twitter. That's the best place to find me, at Steve Ruffley. Join me on my non-fan payrolls. Again, I'm up £1,500 over the last two non-fan payroll live trading sessions. Again, these trading clinics are a great opportunity to speak to me one-to-one, get my charting analysis, get my views on higher time frame trading. I'll tell you what I think. It's not a solicitation to buy, and I'm certainly not going to take any blame or responsibility for people's trading actions, but I went short the Swiss, told you exactly where I went short, told you the reasons why, and I think the market is going to drift off now, and I'll probably take profit at 0.93835. But again, guys, you know, it's all down to individual. I can open the door, as I say, in trading, but I can't trade for you. I can only take you half the way there. Trading's a marathon or a sprint. Any other cliched thing I can say, it's damn difficult. And I've spent 10 years doing these things. So when I say things, you should listen. Because if I stop saying them and I stop doing these things, then, you know, I don't see anybody replacing my space and my time with free trading education to this standard, and to somebody who's made so much money live in front of people. Okay, I just don't see where that's going to come from. Yeah, like I said, if I say buy or sell, that's just what the market is looking to view to do. It's not me telling you to buy, sell. If you want to give me your account details, Ahmed, I'll trade for you. I can do that, but I'll charge you 20% and £1,000 a month. Until that, mate, you know, then you just get in the back of free advice. You know, that's all it is. You've read the disclaimer, so I can't really make it any clearer than that. All right, guys. Well, it's been a pleasure. We're just over time now, so thanks to Maud, Vicky, and the guys at FX Street. Anything else you guys want to know, you can find me. Okay, steve@intertrader.com is the email. You can always get me on that, guys. Try and keep the questions short and to the point. You know, I'm a busy man, but I will try and answer all the questions I can. Dollar versus the Swiss is drifting off now. We've rejected them highs, so I'm happy to stay low. You know my target point, 0.93875. If we break lower end of the Bollinger Band, 0.93646. Press print screen now. Paste that into a Word document or a Paint document, and you can see my levels and all the major products I trade. They will all work to some extent. Buy and sell. Okay, guys, been an absolute pleasure. So I hope you enjoyed the session, and I'll speak to you all very soon. Okay, good afternoon.